Welcome back to the Investing on the Go podcast, brought to you by FundCalibre. Technology touches almost every part of modern life, yet many investors still see it through a narrow lens. In this episode, we explore how the technology opportunity set has evolved and where real growth is emerging beyond the headlines.
Hello, I'm Darius McDermott from FundCalibre, and this afternoon I'm joined by Jeremy Gleeson, who's the manager on the Allianz Global High Tech Growth Fund. Jeremy, how are you?
I'm really good, thanks, Darius, and Happy New Year to you.
And to you, mate, as well. Absolutely. Jeremy and I have known each other for a long time, and he's always a go-to when I need some guidance or some technical knowledge, if we're honest, around the sector. So look, I think a lot of our listeners and people, when they think of technology, they think of their computer, their tablet, their hardware, maybe even as far as their Apple Watch. But technology is much broader than that just opportunity set. What way do you look at technology? Tell us a little bit about the subsectors that you have available to you.
No, you're absolutely right there, Darius. Technology is so broad these days, touching upon almost every aspect of our lives, every aspect of a company's existence, and beyond. So I go into this with a very open mind. I believe that most technology companies or companies that have a sort of a technology DNA don't necessarily think about being classified as a technology company when they either start or when they decide to go into a new area of business, which might be something that their skill set lends well to. And we've seen this over time. We've seen, the likes of Google, Alphabet, as they're now known, start off as a search engine. And now they're starting to put autonomous vehicles on the roads in the US and soon in London as well. We've seen Microsoft start off as an enterprise software company, now making games consoles and video games. And Apple have kind of sort of jumped across all over the place. So, the important thing is to think, is the company got sort of a technology first mindset, regardless of where they're based? So we're now finding technology companies which are classified as financial services companies, industrial companies, consumer, obviously. And that's just going to continue. So it's more about the DNA of the company rather than are they being classically identified as a technology company.
So when you're starting your process and you're thinking, what sort of buckets, if you like, do you break those down into? And I suppose the secondary question is, which of those areas are most attractive today, whether it's valuation or high, given the name of the fund is high growth, which areas are you focusing on at the moment or think are most attractive?
Yeah, every time you go to classify or categorize, it's challenging because so many companies span so many different areas now. One of the easiest ways I think to look about what the opportunities are is by looking at who the ultimate end customer is. So in that order, we kind of look at enterprise spending. We look at telecom services spending. We look at government spending. We look at consumer spending. And there's more categories as well out there. Yeah. But those are sort of maybe four of the bigger ones. And then we look at seeing, who is spending and why they're spending and what are the opportunities for the companies that are providing services or products into those spending categories. So clearly, a great backdrop is that enterprises around the world realize that they need to do more, increase their productivity, but also at the same time cost optimize. They need to do that. They need to do more with less. And technology is at the heart of pretty much all of those initiatives. So enterprise spending is a great area to be exposed to if you're a company. If you can sort of get access to companies' IT budgets, it's a great place to be. And then consumers are just more savvy about spending on technology today. It's at the forefront of a lot of consumers' minds, whether that's your teenage children or even your elderly parents. And so therefore, if there are companies who are producing products which are finding themselves attractive to various levels of consumer, that's also a great place to be because more discretionary spend is focused on technology spending today than it was in the past.
Well, maybe that leads me nicely or not nicely on to where the big spend is. And it would be inappropriate, although I don't want to do the whole section on AI, but clearly that's where the big hundreds of billions of dollars is being spent in the race to AI, generative AI, the chase, or whatever, however it's classified. There's a lot of spend in that area. Is that something that worries you? Do you expect a lot of returns on the investments in those high spend, or we know it will increase productivity, we know the winners will win big? How are you seeing the whole AI thing, given that we're now technically, I suppose, into the third year of the AI race?
That's right. I mean, if things changed very dramatically in late 22 when we had the chat GPT moment, we are seeing a huge amount of innovation and breakthroughs take place constantly around AI. Doing the maths on some of the investments that are being made or have been made and the potential ROI, the returns on those investments in the future, are challenging at the moment.
Yeah,
because we don't know what the future lies. But at the moment, we've got half a dozen companies, maybe a few more, who have all got the opportunity to be long-term AI winners. And none of them really right now want to sort of step away from that potential race to be part of the AI of the future. So
yeah,
there are, I understand there'll be some concerns that some of the spending is without merit. And that's something we need to keep an eye on when spending goes beyond sort of, something that is there to sort of deliver an outcome to being spending for the sake of spending, almost egotistical spending.
Yeah.
But we don't believe we're there yet. We see that the opportunities are rising. The technology is getting better. There are going to be more use cases for AI in the future. We're starting to see some of them come through. I've already mentioned autonomous vehicles.
Yep.
That is, just really wouldn't have been able to exist if it wasn't for artificial intelligence. We've seen the likes of Alphabet roll out in several cities across the US now, where there are fleets of autonomous vehicles driving around next to manned cars. We're starting to see some emergence of humanoid robotics. It was a big talking point at the Consumer Electronics Show in Las Vegas a year ago, and it's continued to be another talking point at the Consumer Electronics Show that took place just last week. So the opportunities are expanding, but we've got to keep an eye to make sure that the spending is not getting completely out of whack with what those opportunities are.
Yeah. So I think we always think of technology as a high growth, interesting sector, comes with some volatility, but the returns certainly in the last 10, 15 years have more than rewarded those ability to take risk. What about some slightly less sexy or even dull areas that are maybe benefiting as a second derivative of some of the spend on AI or all this innovation that's going on generally?
Yeah, there's certainly some of those as well. I mean, a year ago, we flagged one of the themes of 2025 to be around high-speed networking. Particularly, we were talking about optical communications, optical components. Optical components have been around for decades. They've been what's kind of powering our internet for the last 20 plus years. But that whole area of spending has historically been very much tied in with telecom spending. And telecoms companies are very cyclical in their spending cycles. So those companies that supply optical components enjoy peaks and troughs from the spending of telcos. Those components are now being used inside the AI data centers that are being built. And so these companies are actually enjoying a secular growth tailwinds, which they haven't enjoyed for quite some time. So they've gone from being these sort of somewhat boring, very cyclical, somewhat unpredictable companies dependent on a very select customer base to now enjoying secular growth as well. And, we've had some fantastic returns in some of our optical companies. And we think 2026 is going to be a great year for them too.
Another thing that comes up, and this isn't just a technology index issue, but actually an S&P index, which is the concentration, the well-known acronym MAG7 in the S&P being approximately 40%. But an even bigger challenge for technology investors is that Apple, Microsoft, and NVIDIA make up circa 50% of your index. So mathematically, under the rules of which you run funds in Europe and the UK, you can't have 50% in three stocks. I know you've been in and out of all of those, but what other opportunities outside those three hyperscalers, I believe they're now called, but what other technology companies are interesting you?
Yeah, so I guess the benefit, there's obviously a challenge because we can't own index weights in those positions or full weights in those positions. But the opportunity is actually, it gives us the opportunity to diversify a fund far more than the index would be diversified. Yeah. And it does that on three levels. One is from a market cap perspective. We can delve down into mid caps and small caps more than the index does. We could do it on a geographical basis. Those three companies that you mentioned are all US companies. So we can be a lot more international with our exposure in the fund. And then from a sector perspective, which we kind of touched upon at the beginning of the podcast, which is we can look outside the technology sector to find interesting companies outside. So, I mean, we've got a portfolio of just over 50 stocks. Only three of them are those big three that you mentioned. So there's a lot of other interesting names across semiconductors, software, hardware, comm services, etc. We can get exposure to names in Asia, which your typical investor based here in the UK would not have heard of. We can tap on to our very well-resourced colleagues in Asia who are looking and analysing at Asian technology stocks on a daily basis and pick ideas from them. We use our own research capabilities here in Europe to identify companies in the US and Europe, which we can get exposure to. So just being able to move away from the index and being active is really, really important.
I think it's interesting then, because I know you have colleagues out in Asia, but when one thinks of the AI race, but generally the most tech, obviously it is mostly listed in the US. Do you think Asia is playing catch up? I know you've added to Samsung Electronics, for instance. Or do you think, the Asian powerhouses are there? They're just a small part of the index.
Yeah, I think the Asian powerhouses are there. And something's changed over the last sort of 10 years, maybe, is that, Asia, for the largest part, when you thought of technology, they were largely just used as the outsourcers for Western demand, whether it was providing IT services, or making semiconductor chips or putting hardware together. But there's something that's changed in the DNA in Asia. And now we're seeing a lot of innovation really start to push through. And we saw some of that almost 12 months ago when we saw the Chinese breakthroughs in AI with the DeepSeek announcement.
Yeah.
And then we noted the fact that, Alibaba are, building their own large language models. They're at the forefront of this stuff as well. We clearly know that Taiwan Semiconductor is the leading foundry globally and have sort of, competed against the likes of Intel very, very successfully for many years now. And now we're starting to see that sort of really almost sort of spread out down the market cap spectrum in Asia as well. So mid caps and smaller cap names are also sort of demonstrating how cutting edge they are with their technology, rather than just being a manufacturer of products which have been designed by an American or European company.
And that's a differentiator for your franchise, isn't it? Those mid and potentially smaller companies, but also that geographical diversification. Not there's anything wrong with the hyperscalers. They've made a lot of money over the last 10 years, but you can add a slightly different flavor of in a technology fund.
Yeah, absolutely. And yeah, we are, our view is that we have lower weights in the hyperscalers, the Mag 7, than maybe the indices. But it's not because we don't like them. It's just because we want to ensure that there's good diversification in a broad portfolio. And so we can identify companies who are benefiting from some of those big trends out there, but they're just off the radar screen, and therein lies the opportunity regards to valuation and growth, etc.
So another area I'd like to touch on is super interesting and leads to individual and enterprise spending, but of course is cybersecurity. For all the newfangled technologies that we've come to actually think of as every day, we need companies and people to businesses to protect consumers and business. I see you've got Palo Alto, Arista Networks, which I think you call digital plumbing. Tell us a little bit about your exposure to cyber and some of the interesting things about it.
Yeah, I mean, some of these companies are just working away in the background. Many people just wouldn't have heard of these companies or aren't aware of what they do, simply because they're not the marquee names that get mentioned in the press or have that sort of marquee consumer branding that we know. It's these companies that enable things to happen, whether it's protecting us or just enabling the internet and AI applications and workloads, the app store to run, etc.
Yeah.
Those companies you mentioned, Palo Alto, Fermi, and Cybersecurity, protecting your digital assets, whether you're a consumer or an enterprise, is very, very important. Protecting your intellectual property is very important. And we know that the bad guys out there are attempting to steal data and intellectual property. And it's important to have a cybersecurity strategy that helps protect your assets. The interesting thing about cybersecurity is that it's maybe a little bit less cyclical than other areas of IT spending. So companies have to kind of spend on cybersecurity regardless of whether their business is booming or they're going through a more challenging economic time.
Yeah, I was going to ask, it feels to me like it's a non-discretionary item. You have to have that if you're a company, certainly companies that deal with data, etc. And are you starting to see some of those cyber names that you invest in or that you watch that really are starting to get bigger spend of company wallet?
So it's an interesting one, because when a company's enjoying significant growth, when the economy is booming, they don't necessarily need to increase the amount of spending on cybersecurity. So they would likely more spend on areas which are going to help them sort of support that growth.
Yeah.
But the flip side is that when times are more challenging and belts are being tightened, cybersecurity is not an area where you're typically going to go and cut spending either. So the interesting thing is the cybersecurity, there was a kind of sort of, I guess, a step function in demand, which took place 6 years ago when COVID kicked in. And employers suddenly had to support their employees working from home, and it changed the cybersecurity environment quite significantly for companies. So they had to step up spending to support sort of remote access and work from home environments. So now we're seeing a sort of a platformization taking place around cybersecurity, where companies are looking to work with fewer vendors but do more with those vendors. And our sort of goal is to identify the vendors that are going to be the winners in the platformization trends and invest in those.
But also as well, when you say, whilst historically some of the spending may have been cyclical, actually now you should, that there's a minimum spend. Companies can't cut their spending because the threat to companies and individuals from cyber attacks that we hear and read about every day is so great. So at least you've got that good longevity of cash flows from some of those companies, which, nothing wrong with good, stable cash flows.
That's exactly, which is one of the reasons why we like these companies. They've got much, very predictable revenue. They've got very predictable cash flow. And if you're an enterprise or a company which has got predictability, then it means that you can plan for the future better and puts you in a very good shape with regards to investing in new technology or even deciding to make acquisitions to sort of expand your product portfolio.
Yeah. And just approaching the end of our chat, Jeremy, one of the things which has come up, and I think it's more of a 3-6 month phenomenon, but certainly continuing apace, is, are we in another bubble? Is this the AI bubble the same as the tech bubble of the late 90s into the early noughties? I think obviously it comes on a company by company basis, but it does feel as if whilst on elevated PEs, they're not at the same ridiculous levels that they were around the .com.
No, I mean, I think there's been a lot of commentators out there who have been very quick to draw parallels to the 99-2000 period. Maybe I will flag some of the differences.
That'd be useful. Thank you.
One is in terms of overall financial market behavior. We're not seeing the huge flood of IPOs take place, with lots of capital being raised for companies with unsustainable or challenged business models. We haven't seen aspects of just broad-based excitement over all aspects of the technology sector or equities as a whole. So even within the technology sector, there are very big ongoing debates right now as to the future of the software industry. Some people think that software companies are in a very good position to be the AI winners of the future. And some people believe that they will be displaced by AI in the future. And that's very much reflected in their valuations. Software companies have seen a sort of a contraction in their valuations over the last several years since we had sort of the ChatGPT moment. And then, and thirdly, just from a valuation perspective overall, I think people who sort of are considering AI as a bubble, the company which is probably most synonymous with that is NVIDIA, the maker of graphical processor units which are used in AI. And currently that company, if you look at 1 year out, despite the fact that the company is growing very substantially, is trading on an S&P like multiple, if actually possibly even at a discount to the S&P.
Yeah.
Which doesn't strike me as optically something that you would expect to see in a bubble.
So finally, maybe just a slightly slightly more light-hearted type of question. The one thing I do, I struggle to keep up with what's going in technology, but it is your day job. And is there any areas that you've spent more time in the last 12 months thinking about, or any areas you think in the next 12 months I really have to learn more about a new technology or a spin-off technology that maybe lay people like myself don't know about?
I think something that we're going to be hearing a lot more about over the coming months is around space technology, space tech. And this is an area which, a little bit like AI, has had several false storms in the past. Lots of excitement built up, subsequently to be sort of disappointed. We will likely see a company spin out called SpaceX at some point this year. We are seeing an increased amount of sort of revenues associated with space-related technology and communications. So we're going to start to see some aspects. I'm not really sort of that excited about areas of space tourism, which obviously got a bit of attention a few years ago.
Yeah,
but it's more about use of satellites to enhance communications and how those satellites are arguably monetized going forward, which I think could be very, very interesting. So it's an area which I would say that I've done relatively little work on in years past. I probably need to do more as we go into 2026. I am falling back on the view that I think one of the ways that we will probably look to make investments in this area is through our exposure to semiconductors, because of the quantity and value of semiconductors which get put into satellites and the like.
Yeah, well, I can tell you, having followed SpaceX personally for a number of years, if we think Nvidia's on a high PE, even though it is yet to list, SpaceX is on a very juicy valuation.
Oh, yes, very much so.
So look, that seems an obvious place to say thank you very much. So thank you, Jeremy.
This multi-cap global technology fund focuses on high-growth companies with proven business models. Jeremy Gleason was previously a long-standing elite-rated manager before he moved to this new fund, and we're excited to see what his new team of experienced investors can do at Allianz. For more information on the Allianz Global High-Tech Growth Fund, please visit FundCalibre.com. And whilst you're there, don't forget to subscribe to the Investing on the Go podcast, available wherever you get your podcasts.
Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at the time of listening. Elite ratings are based on FundCalibre's research methodology and are the opinion of FundCalibre's research team only.